Today, we are going to look at a company that I am currently thinking about adding to my portfolio, and we are going to use MetisOne as a tool just to check out if this valuation is good for the company or what the future can hold. If you come and join Metis, you can also just have a dashboard about your general investments. You can check your portfolio, collect the dividends, and see how it's going to perform in the next years, and also just calculate out what's the risk of your portfolio. So you can just simply add your stocks here and just see what's going on with them, and you can see also how the dividends are going to affect your future incomes. So if you want to use Metis as a great tool, just feel free to join in the description. And today, as I said, we are going to take a deep dive into Duolingo and find out why it has been decreasing in the price, and also what the future may hold for this company. As you may see, we already loaded in the stock. The current stock price is about 153, and you can see that in the past 6 months it has been absolutely hammered. So it came all the way down from the 500s ish, and now it's trading at this, well, you could say cheaper price, but we will find out if it's actually really cheap or not. For this, we would have to just see they have IPO'd very recently in the past 5 years. So we are talking about a relatively new, probably growth company. And in terms of their valuation, this will also be very, very important. So we can have the possibility to look into their financials, and we can absolutely see that their revenues has been growing very, very nicely from 2022 and until the most recent datas. Obviously, Q4 will be super important into the total picture, and also just the closing of the 2025. We will get a picture in a few weeks, and that I think will also help us to get a greater value in terms of visibility. So we can see that the company is absolutely printing money in terms of their profitability. So it has been pretty nice that they become profitable at this point, and obviously in the future they also plan to be profitable. But here comes the question: why did the stock price sink from 500 to this area? Well, they have been pushing artificial intelligence a little bit further, as I think they should have. So, for example, putting most of the possibilities into one bracket and saying that AI is going to be a game changer for this company very, very soon. Well, I guess in the long run it will absolutely help the company, but analysts had a different idea about how the company should hit its targets. So since it hasn't been hitting those targets and those growth, obviously there has been in a decline in the shares. But I don't think in these cases this is something that is a huge problem. We can see that the company has been doing very well in terms of their cash flows. So you can see that there is a quite large stock compensation, but obviously it's something that how founders or large shareholders getting paid out. You can see that the capex has been declining, but you can't really pull a line and see a great picture about it. But also that the well, if it's they're not repurchasing stocks, they are not paying out dividends, so it's in a very early stage yet. And you can also see in their balance sheet that they don't really have any debt. So this company has a lot of possibilities going out from this position, since they're basically debt free, and so they have a bunch of cash sitting on their bank account, and that gives them an opportunity to basically go out and then figure out how they could grow. So we can see, if we go to their metrics page, that the current PE ratio is around 19. Well, this is recorded on 22nd of January, and their forward PE ratio around 26. Obviously, it depending on how will the 2026 performance actually go. And then we can see that their market has declined a lot. So in terms, it almost next to enterprise value, which is quite weird. And you can see also that their earnings per share is around $8, sorry, which is awesome. And then if you look at the next years, it's also gonna be sitting here in this area. Their gross margins are extremely great, and also their net margins are adding up at 40%, which is absolutely great. And then their return on equity is 36%. Which is awesome. So if we would look at their valuation, we're gonna use the discounted cash flow model. You can see that the calculator is suggesting an 18.8% growth. We can just accept it by clicking on it, but also we can just change it to our own differentiation from each investor to others. So you can just put your own there if you would like to, or just accept what the system gives you. You can see that their average growth of the past 3 years was 80%, and then we can just leave the terminal growth rate at 2.5% and accept the suggested weighted average cost of capital. You can also see how it was chosen out. And just by these numbers, you can see that the calculated estimated fair value is around $300, and you can see it in detail. So if you would go out to 2029, how would their projected free cash flows look like? You take them back to current value, and you would have an estimation about this. So this will obviously not be the perfect calculation. There has to be adjusted, or from quarter to quarter you have to adjust it, but you can have a general picture. If we would look at the sensitivity analysis, you can see that what would happen if the WACC would be lower, or the growth would be higher or lower, and you would see all greens, and this is a good sign usually. I think that if there would be a scenario where the WACC would be 11% and the growth would be only 14.8%, you would still end up with $200 per share. Obviously, you can come down and just check what is the current possibilities. If you put just 5% there, you would get that if the company would only grow 1%, and the WACC would be around this 8.7, the valuation is currently hitting those targets. So I would say generally that this valuation, what the company has currently, is more depressed by the market. So there could be an up possibility in my idea, but obviously I don't see the future, so it can change. If we look at just the quick scenario analysis, we can see that with 5% average growth rate and with a 9% discount rate, you would receive this $181 per share, and this is around 20% upside. But if the growth would be 10% on average, the discount rate would be just 8%, you would already see a fair value of $280. So this model can be easily manipulated in both ways. So if the growth rate would be nothing or negative, then you would see that the share price should be lower in this case, and also this is a bear scenario if you want to use. So this gives you a picture on maybe how you should value a company. Just try it out. We can see what analysts are thinking. Analysts are thinking that the average target price is $263, which is much higher. There is 14 that is suggesting a buy and 9 that is suggesting a hold, and no one is saying that it should be sold. So I hope you had a great picture about the company, and also if you are interested in more videos like this, feel free to subscribe to my channel and also join Metis and start analyzing stocks today. Use this tool, it's amazing. You can find good companies very quickly, and even if you just find one, the total yearly subscription will easily pay out for you. So don't forget to join. Everything will be in the description. See you in the next one, and don't forget to put down which stock should I analyze in the next one. Goodbye.